you probably haven't heard of it, and that's exactly what makes it dangerous. Most people think they understand how modern finance works. Banks lend, companies borrow, investors buy bonds. But there's a new system quietly growing in the shadows. It doesn't show up in the same reports. It doesn't face the same regulation, and yet it now controls over $2 trillion of credit. They call it private credit. I call it the quiet giant, the lender that never sleeps, never stops, and never shows its face. After the 2008 crisis, the world changed. Governments told banks to hold more capital, take fewer risks, and lend more responsibly. It sounded good until it wasn't, because when banks stepped back, someone else stepped in. Private funds, hedge firms, and private equity giants, names you've never seen on a local bank sign, began lending directly to businesses. Not a few million here and there, billions, quietly. They built an entire parallel banking system, and one that doesn't take deposits, doesn't answer to regulators, and doesn't play by the same rules. And for a while it seemed brilliant. Returns were high, defaults were low. Everyone, from pension funds to university endowments, wanted in. But as I've learned after a lifetime in markets, when everyone wants in, the exits get smaller. Private credit became the perfect product for a world addicted to yield, safer than stocks, more profitable than bonds, and conveniently invisible. Invisible in the sense that you can't see what's inside these loans. They're not traded on public exchanges. They're not marked to market. They exist in closed books, disclosed only to those on the inside. It's a system built on trust, but not transparency. Here's the irony. We told banks they were too risky, so we forced them to lend less. And by doing so, we pushed all that risk into the shadows, into firms that don't have the same safety nets, the same capital buffers, or the same oversight. It's like trying to make the ocean safer by banning ships, and instead letting submarines roam freely beneath the surface. I've been watching this happen for years. At first it looked harmless, even healthy. Businesses that couldn't get bank loans found lifelines. Investors got their yield. Everyone felt clever. But now the quiet giant has grown too big to ignore. Over $2 trillion in loans spread across thousands of companies, held by institutions that can't easily sell, can't easily value, and can't easily admit when things go wrong. That's the part that worries me, because I've seen what happens when markets built on confidence start to question themselves. The problem with private credit isn't that it exists. It's that no one knows how stable it really is until something breaks. And if history has taught me anything, it's this. When the invisible part of the system gets too big, it always becomes visible the hard way. When people hear the word credit, they imagine a simple transaction, and someone lends, someone borrows, and everyone moves on. But that's not how the modern system works anymore. The machine has evolved, and like any machine, its power lies in what you don't see. Here's how it works. A private equity firm, maybe Blackstone, Apollo, or KKR, raises billions from pension funds, insurance companies, and sovereign wealth funds, money that belongs to retirees, teachers, city workers, people who've never heard the term private credit. They promise those investors a higher return, 8%, 10%, maybe more. Then they go hunting, not for the big famous corporations, but for the ones left behind. Companies too small or too risky for traditional banks. They lend directly, quietly. No bank approval, no public disclosure. These are loans negotiated behind closed doors, handwritten terms, few covenants, no market price, and because no one's watching, they can get creative, mixing loans, equity, derivatives, and promises all into one beautiful, complex structure. It looks efficient, it feels innovative, but it's also opaque. When I used to study balance sheets, I cared about one thing: clarity. You can manage what you can measure, But the private credit world, it was designed not to be measured. There's no centralized exchange, no daily pricing, no clear record of who owes what to whom. If one borrower defaults, it doesn't show up on a screen. It shows up months later when investors quietly write down the value and hope no one asks too many questions. This opacity is the system's strength and its weakness. See, private credit is built on relationships. The lender and borrower often know each other. The deals are bespoke. That works beautifully until the cycle turns. Because when times get hard and defaults start to rise, everyone suddenly wants to know the same thing. What's this worth? And that's the question no one can answer. In public markets, prices fall fast, painfully but honestly. In private markets, prices don't fall at all until they collapse. That's what makes this machine so dangerous. It doesn't look risky. It doesn't even look volatile. But that's only because it hasn't been tested under real stress. I've seen this pattern before in real estate, in tech, in derivatives. The same ingredients repeat: innovation, leverage, opacity, complacency. And then one day something small breaks. A missed payment, a liquidity crunch, a sudden repricing of risk, and the whole network tightens. Because in the shadows of finance, everything is connected by trust, and trust, once questioned, evaporates faster than capital. There's another part to this machine: the incentives. Everyone involved is rewarded for growth, not caution. Fund managers earn fees on assets under management, not on prudence. Borrowers are encouraged to take as much as they can while credit is cheap. And investors keep pouring in because the numbers look stable until they don't. It's the perfect illusion. Smooth returns, low volatility, steady yield. It feels safe because it's quiet, but quiet doesn't mean stable. Sometimes quiet means pressure building beneath the surface. The system has become addicted to itself. The funds need borrowers, the borrowers need loans, and the investors need results. So the cycle keeps spinning, faster, deeper, louder, but still pretending to be silent. That's the paradox of private credit. It promises security, but it's built on leverage. It offers stability, but it hides fragility. And the more it grows, the more it resembles the very thing it replaced: the old banking system before the crash. The only difference? This time, it's not in the headlines. It's off the books. Every system looks stable until you start turning the screws. And over the past 2 years, the screws have been turning fast. Interest rates have risen higher and faster than at any point in modern history. The easy money era, the oxygen this machine depended on, is gone. And now we're finding out what happens when a $2 trillion shadow system runs out of air. I've been through enough cycles to know this feeling. The quiet before the panic. The spreadsheets still look fine. The reports still sound optimistic. But underneath the calm, something is tightening. Borrowers who once paid 5% interest are now facing 12%. Refinancing windows are closing. Deals that looked brilliant in 2021 are suddenly bleeding cash. And because these loans exist in the dark, outside public markets, there's no visible red line, no flashing indicator, just whispers. A fund delays redemptions. A borrower restructures. A valuation is quietly adjusted. One by one, the quiet signals start to align into a pattern, the kind of pattern that's impossible to ignore once you've seen it before. Private credit was built on the assumption that defaults would stay rare, that borrowers would always be able to refinance, that liquidity would always be available somewhere. But now even the biggest players are admitting what they used to deny. Jamie Dimon calls it a $2 trillion unregulated bubble. Analysts whisper about shadow leverage, and still the funds keep raising more. Because they have to. They're trapped in their own design. You see, private credit funds don't just lend, they reinvest. The fees, the interest, the returns all get recycled back into the same ecosystem. When new money stops coming in, the cycle freezes. It's the same feedback loop that broke subprime mortgages, that broke collateralized debt obligations, that broke confidence itself. Different names, same structure. And like before, the weakest links are the ones no one talks about. Small and mid-sized businesses, the real economy, are carrying record levels of floating rate debt. Every rate hike is a silent tax. Margins shrink, layoffs begin, defaults creep in, but slowly, quietly, almost politely, because the illusion of stability depends on pretending everything's fine for just a little longer. Funds call it amend and extend. Investors call it mark to magic. I call it denial with better branding. I've seen this behavior in boardrooms and trading floors my whole life. When people know the truth but can't afford to say it, they speak in euphemisms. Liquidity event, temporary dislocation, technical default. They don't lie outright. They just rename the problem until it sounds like something they can manage. But words don't stop reality. Behind the scenes, cracks are widening. Companies are defaulting quietly, not in headlines, but in term sheets. Funds are limiting withdrawals, suspending valuations, pausing distributions, and all the while the official numbers stay serene. Because in private markets, pain doesn't show up until someone is forced to sell. That's the trap of opacity. It protects you in good times. It suffocates you in bad ones. And yet, here's the paradox. Even now, money keeps pouring in, because where else can it go? Bonds yield less. Stocks feel overvalued. And investors have convinced themselves that private credit is the last safe frontier. That's how pressure works, not as an explosion, but as a slow, relentless squeeze. Until one day, something small gives way, and the weight shifts all at once. When I look at the system today, I don't see panic. I see tension, quiet, invisible, and everywhere, like a fault line deep beneath the surface. You don't notice it until it moves. And when it moves, it doesn't ask for permission. You can always tell when a system is running on borrowed time, not because it collapses all at once, but because the people inside it stop believing their own story. That's where we are now. The confidence is still there on paper, but you can feel it slipping beneath the surface in the way markets hesitate, in the way investors whisper instead of announce. The truth isn't shouted in finance, it's felt. Private credit was supposed to be the future, a smarter, leaner version of banking built by people who said they'd learned from the past. But history has a way of humbling even the confident. And what we're seeing now isn't innovation, it's repetition, the same leverage, the same opacity, the same assumption that liquidity will always be there when needed most. But liquidity, like trust, only exists when people believe it does. And belief, once shaken, doesn't come back easily. I've spent my life studying systems, businesses, governments, economies. And the one truth that never changes is this: everything works until it doesn't. For a while, private credit looked invincible. It grew quietly, steadily, feeding on a decade of cheap money and low volatility. But those same conditions and the ones that built it no longer exist. Rates are higher, borrowers are weaker, transparency is thinner than ever. And that's what makes this the perfect time bomb, not because it will explode tomorrow, but because no one knows when it will, and no one's prepared for when it does. It's not just a financial risk, it's a philosophical one. We've built an entire culture on the idea that someone, somewhere, has it under control, that there's always a safety net, a central bank, a bailout, a backstop. But what if this time the risk lives outside the system that can save it? What if the next crisis doesn't start on Wall Street, but in the shadows beneath it? That's the danger of the unregulated. It grows quietly, invisibly, until the day it can't. When that day comes, it won't announce itself. There won't be flashing red lights or headlines that say collapse. It'll start with silence, a redemption delayed, a valuation revised, a statement that says, out of an abundance of caution. And then, slowly, the quiet giant will begin to stumble. The funds will shrink, the loans will tighten, and the confidence that once held everything together will start to evaporate. You see, crises don't destroy systems, they reveal them. They show us what was real and what was only ever sustained by belief. The question isn't whether the private credit machine will break. It's whether the system that depends on it can survive the truth when it does. I've seen enough to know this much. The greatest risks are never the ones that scream the loudest. They're the ones that stay quiet, just beneath awareness, feeding on the assumption that they're under control. That's what private credit is today. Not a villain, not a savior, just another reflection of our own illusion that debt can defy gravity. But gravity always wins. The $2 trillion time bomb isn't ticking in secret anymore. It's ticking in plain sight, in the portfolios of pension funds, the balance sheets of companies, and the complacency of those who think this time is different. It never is, so what do? We pay attention. We question what looks too smooth, too quiet, too consistent. We stop mistaking silence for safety, and we remember every bubble in history was built by people who thought they were smarter than the last ones. The cycle always ends the same way, with humility, with pain, and if we're lucky, with wisdom. The machine will keep running until it doesn't, and when it stops, we'll all find out what was real and what was just credit pretending to be wealth.